Every financial network and every central bank research desk is telling you the same story right now. De-dollarization is a slow, decades-long process, and the dollar's dominance is safe for the foreseeable future. That reading is not just shallow, it is dangerously wrong. And the evidence that it is wrong is sitting in plain sight inside the IMF's own currency composition of official foreign exchange reserves database. A database that almost nobody reads past the headline number. The dollar's share of global reserve holdings has dropped from 71.5% in 1999 to 57.4% in Q4 of 2025. That is a decline of 1 percentage points in 26 years. The consensus describes this as gradual. I want to show you why, in 2026, the pace is no longer gradual, and why 8 specific currencies are positioned at the edge of that acceleration. By the end of this video, you will understand 3 things that the currency markets are not pricing in. You will understand why de-dollarization in 2026 is structurally different from every prior episode. You will understand the specific mechanism by which currency collapse in this cycle will not look like the crises of 1997 or 2008. And you will understand which 8 currencies carry the fatal combination of characteristics that makes their deterioration not a risk, but a schedule. 3 things. First, the current de-dollarization wave is driven not by ideology, but by architecture. Sovereign nations are building parallel payment rails that make dollar dependency optional for the first time in 80 years. Second, the 8 currencies I will identify today share a specific structural vulnerability I call the hollow reserve trap, which makes them look stable on the surface while their foundational support quietly evaporates. Third, the sequence in which these currencies break will matter more than which ones break, because the sequence determines contagion. I am Professor Jiang. On this channel, we do not do panic and we do not do cheerleading. We follow the logic of power. We follow the incentives. And when you strip away the emotion in the headlines, the picture always becomes clear. Let me start with the facts, because you need the ground beneath your feet. The IMF's COFR database through Q4 2025 shows global central banks now hold $11.37 trillion in identified foreign exchange reserves. Of that, $6.52 trillion, or 57.4%, is denominated in U.S. dollars. In 1999, when the euro was introduced, that dollar share was 71.5%. Every percentage point of reserve shift represents approximately $113.7 billion in reallocation. Central banks reallocated roughly $1.6 trillion away from dollar-denominated assets over that 26-year period. Here is what the consensus misses. The pace of that shift accelerated sharply after February 2022, when the United States and its allies froze $300 billion in Russian central bank reserves held in Western custodial accounts. The Russian freeze did something no academic paper had predicted. It demonstrated to every central bank on Earth that dollar-denominated reserves held in Western systems were not unconditionally sovereign assets. They were conditional assets, and conditions can change. According to a January 2026 working paper by economists at the Peterson Institute for International Economics, central banks in the Global South collectively reduced their dollar reserve allocations by 6.2 percentage points between February 2022 and December 2025, faster than the preceding 12 years combined. China's share of reserves held in non-dollar assets crossed 78% in November 2025, according to the People's Bank of China's quarterly bulletin. The BRICS payment settlement system, now including Saudi Arabia, the UAE, Egypt, Ethiopia, Iran, and Argentina alongside the founding members, processed $847 billion in trade settlement during 2025, bypassing SWIFT entirely. Goldman Sachs estimated in its February 2026 Global FX Outlook that an additional $1 trillion in annual trade flows could migrate off dollar rails by 2028. I want to give this a name, because once you see it, you cannot unsee it. I call it the hollow reserve trap. The hollow reserve trap describes the condition of a currency that maintains the appearance of reserve status. It is still accepted, still traded, still held, but whose foundational demand is eroding at the layer beneath the surface. Like a building whose steel columns have begun to rust from the inside, it holds its shape until it does not. The currencies most vulnerable to the hollow reserve trap are not the currencies of the weakest economies. They are the currencies of economies that built their stability on dollar-correlated trade flows and dollar-denominated debt that are now beginning to rout around the dollar system. Imagine a town with one general store that everyone depends on for everything. Food, medicine, hardware. Every essential. The store's owner prints the only currency the town uses. Every farmer sells to the store, every worker earns from the store, and everyone settles debts in that currency. Now imagine a cooperative warehouse opens on the edge of town. Slowly, quietly, the farmers start selling directly to each other. The workers start settling wages in barter agreements. The general store's owner still prints the currency, but fewer and fewer transactions require it. The store is still open. The lights are still on. But the structural demand for its currency is being rerouted. That is exactly what is happening to the dollar-centric currency system, and the 8 currencies I will describe are the ones most dangerously positioned at the frontier of that rerouting. Layer 1. The obvious evidence. The currencies directly correlated to dollar-denominated commodity contracts, particularly the currencies of nations that invoice their primary exports in dollars, are the first to lose structural footing when dollar-denominated trade declines. The Nigerian naira, the Egyptian pound, and the Turkish lira have all lost more than 40% of their purchasing power against the dollar in the last 24 months, not because their economies are uniquely mismanaged, but because the dollar-denominated revenue streams that once supported their reserve accumulation have become unreliable. Layer 2. What almost nobody connects. 3 of the 8 currencies I am identifying are not developing market currencies at all. They are the currencies of developed economies whose trade architecture is now being structurally severed from dollar rails. The Japanese yen, trading at 161.4 per dollar as of August 2026, the weakest sustained level since 1990, is experiencing what the Bank of Japan's own research division described in June 2026 as a structural recalibration of external demand for yen-denominated assets. That is central banker language for the yen's foundational buyers are stepping back. The South Korean won and the Thai baht are experiencing parallel pressures for the same reason. Their export economies are reorienting toward Chinese yuan-denominated settlement under bilateral agreements signed in 2024 and 2025. Consider what this means for the Japanese yen specifically. Japan's current account surplus, the traditional anchor of yen strength, has narrowed dramatically as energy import costs, denominated in dollars, have consumed what was once reliable export revenue. The Ministry of Finance's July 2026 data shows that Japan's monthly trade balance has been negative for 21 of the last 24 months. A country running persistent trade deficits does not accumulate the foreign reserves necessary to defend its currency in a sustained speculative attack. The Bank of Japan's total foreign exchange reserves stand at $1.23 trillion. Substantial, but already drawn down by $61 billion through interventions since January 2025. At the current pace of intervention, those reserves have roughly 19 months of runway before the central bank faces a political choice between defending the yen and funding the Japanese government's bond market simultaneously. It cannot do both indefinitely. And that constraint is the definition of the hollow reserve trap operating at the level of a G7 economy. That is not a developing market pathology. That is the architecture of fiscal dominance, reaching a currency that most Western investors have treated as a safe haven for 40 years. Layer 3. The connective tissue. The 8 currencies that meet the full criteria of the hollow reserve trap in 2026 share 3 characteristics simultaneously. First, more than 60% of their primary export commodity is invoiced in U.S. dollars, creating a hard dependency on dollar demand that is now softening. Second, their sovereign debt to GDP ratio exceeds 75%, meaning they cannot absorb a currency depreciation through reserve liquidation without triggering debt rollover crises. Third, their central banks hold less than 4 months of import cover in liquid reserves, the IMF's own threshold for adequate buffer. The currencies that meet all 3 criteria as of July 2026 are the Argentine peso, the Pakistani rupee, the Egyptian pound, the Nigerian naira, the Turkish lira, the Sri Lankan rupee, the Japanese yen, and this one will surprise you, the British pound sterling, which now meets 2 of the 3 criteria following the UK's October 2025 fiscal event. Layer 4. Memorize this number. 6. $3 trillion. That is the estimated volume of dollar-denominated debt held by non-U.S. entities globally, according to the BIS Quarterly Review from March 2026. Every one of these 8 currency economies carries a portion of that debt load. When their currencies depreciate, the dollar cost of that debt service rises in local currency terms without any corresponding increase in revenue. The economists call this original sin. I call it the final turn of the hollow reserve trap. That is not a currency crisis. That is a structural debt trap activated by a currency move that was already in motion. Before I continue, I want to present the strongest possible counterargument because I owe you the real debate, not a simplified version. The Steelman for dollar dominance is formidable. No alternative currency has the depth, liquidity, and legal predictability of U.S. dollar markets. The euro has been structurally fragmented since the 2012 sovereign debt crisis. The Chinese yuan remains non-convertible, meaning foreign central banks cannot freely buy and sell it without encountering capital controls. The BRICS payment system processes hundreds of billions, but the dollar system processes $6 trillion per day in foreign exchange markets. The argument concludes that de-dollarization, even if directionally correct, will take decades, not years, to reach a systemic threshold. The Steelman describes the current architecture of global finance accurately. It does not describe the incentive shift that occurred in February 2022, and it does not describe the speed at which payment architecture can be rebuilt when sovereign governments treat it as a national security priority. China did not build the cross-border interbank payment system by waiting for market conditions to evolve. It built it deliberately, politically, over 15 years. The system is now operational for 43 currencies. The pace of adoption in 2025 alone doubled the prior 5-year cumulative total. The structural rerouting is not theoretical. It is operational. Write these down. Come back to this video in 90 days and tell me whether I was right or wrong. Prediction 1. Before December 31st, 2026, the Japanese yen will breach the 170 per dollar threshold, not in a speculative flash event, but as a sustained level reflecting ongoing capital outflows from Japanese government bond markets. The signal to watch is the Bank of Japan's weekly reserve reporting. When liquid reserves drop below $1 trillion, the floor is gone. Prediction 2. Before the end of Q2 2027, at least 2 of the 8 currencies I identified will implement formal capital controls, restricting outflows to defend their exchange rate pegs or managed float bans. The signal will be a sudden, unscheduled central bank announcement on a weekend. Weekend announcements in currency markets are almost never good news. Prediction 3. By the first quarter of 2028, the IMF's CUFR data will show the dollar's share of global reserves below 54% for the first time, crossing a threshold that the IMF's own 2022 working paper identified as the level at which reserve diversification becomes self-reinforcing. When that happens, the process no longer requires a political decision. It becomes an automatic institutional behavior. 3 things to watch. Watch number 1. Monitor the weekly Tokyo foreign exchange intervention data published by Japan's Ministry of Finance. Japan has already spent $62 billion defending the yen in 2024. When intervention frequency rises to more than twice per month, the ministry has lost the initiative. That is the leading indicator for a disorderly move. Watch number 2. Track SWIFT's monthly messaging data for the percentage of trade finance messages settled in currencies other than the dollar. SWIFT publishes this quarterly. When the non-dollar share crosses 25%, it currently sits at 21. 3%, the rerouting of trade finance has reached a self-sustaining threshold. Watch number 3, and this is the one that matters most for your household. Watch your own currency exposure. If your retirement savings, your bond holdings, or your cash positions are entirely denominated in a single currency, Including the dollar, you are carrying concentration risk in a period of structural monetary realignment. Assess whether any portion of your portfolio has access to assets denominated in currencies that are gaining, rather than losing, reserve share. Consider the role of hard assets, gold, real assets, inflation-protected securities, in a period when the value of paper currency is being structurally renegotiated. I have put together the 47 specific positioning strategies for households navigating a de-dollarization environment, the allocation frameworks, the account structures, the specific instruments in the crisis preparation blueprint. The link is in the description and pinned in the first comment. Most households recover the cost in the first week. Every empire in history believed its monetary architecture was permanent. Rome believed the denarius would always command the Mediterranean. Spain believed the silver real would always settle the world's accounts. Britain believed sterling's role as the global reserve currency was a permanent feature of civilization until August 1971, when Nixon closed the gold window and Britain found itself holding a reserve currency whose anchor had been removed without a replacement. None of these transitions happened in a single crisis. They happened as a slow renegotiation of a bargain nobody had written down. The most dangerous currency is not the one that collapses in a visible crisis that everyone can point to. It is the one whose reserve demand quietly erodes across 100 bilateral agreements, 100 trade invoicing decisions, 100 central bank allocation meetings, until the morning when the structural demand that was always assumed to be permanent simply is not there anymore. If this showed you something the headlines never will, subscribe. This story is going to move fast, and I will be tracking every signal as it develops. Tell me in the comments, which of the 8 currencies do you believe breaks first? The yen, the pound, or one of the developing market currencies I named? I read every response, and your questions shape the next analysis.